Hi. Well, today I'm going to talk to you about banks. And before you UK listeners, European listeners, Australian listeners go and switch off, let me give you the bad news. And the bad news that this affects you as much as it does the American viewers. So I suggest you listen. Now, the first thing I want to do is get a couple of terminologies straight. And the first thing is to talk about a little thing called derivatives. Now, you'll have all heard it on the news that derivatives are horribly complicated, that back in the days of the housing crisis hardly anyone understood them. Well, it's true that the ins and outs of derivatives are fiendishly complicated and the terms and conditions are terribly complicated, but the basic principles are actually easy for anyone to understand. Imagine a horse race. Now, in a horse race you would back a horse to win, but you can also back a horse to lose. And it's exactly the same with derivatives. All a derivative is a fixed term contract, so it has an end date, and you bet on which way you think the market is going to go on a particular commodity. Now, you may think that that sounds simple enough, but it's slightly more complicated than that in that you get different types of derivatives, and the most popular one is where you predict an actual price range. So you might say, for example, that I predict that in 3 years the price of gold is going to be within 3% of where it is now. And that would be the type of thing that a simple derivative would cover. But it gets worse than that. Imagine a roulette wheel, and you have not just one ball, but you have 3, maybe 4, maybe 5. And your derivative is predicting that all 5 of those balls will land on particular numbers. Well, this is a complex derivative, and this is mostly what the banks deal in. They will say something like, oh, by the end of 2017 the price of oil will be between this and that, the dollar will be at this level, and the price of gold will be such and such. And these commodities can be anything. It can be wheat, can be corn, can be cotton, could be copper, could be absolutely anything, even the price of houses. So long as there is a government sanctioned figure that they can bet on, because that's what it is, they will bet on it. And this is the problem with derivatives. It's basically a big banker's casino. Now, how much money have they been gambling? Well, I don't have exact figures for Europe, although there are some people who say that the National Bank of Germany has gambled something like $130 trillion in this way. I have figures for the US, which basically says that it's $247 trillion, and that's just for the top 5 US banks. How many smaller banks are players as well? Probably all of them. But it's a staggering amount of money. So that is all about derivatives. And the next thing is about a bail-in, and you may think that if you're in the US this doesn't cover you. We know all about bail-ins in Europe. They've been happening in Greece, to a limited extent in Italy, and basically this is where the bank turns around and takes all your money and won't let you get hold of it. Now, in the old days what used to happen is that a bank would start to fail, there'd be a run on the bank, there'd be queues outside the doors, and the bank would immediately shut the doors. And the reason for that wasn't to hold on to your money. The reason for that is because they needed to work out how much money they had, whether they were in fact bankrupt. And if they were bankrupt, then they had to work out how that money would be distributed amongst the depositors and the other creditors of the bank. But that's the old way. Now the G20, back in 2013, it was reported in a few mainstream media sources, set up bail-ins for banks internationally, and this included the United States. And what that means is that now, when you pay your money into the bank rather, you are in fact loaning it to the bank. Your account conditions are in fact now a loan agreement where you loan your money to the bank and they can do pretty much whatever the heck they like with it. Now specifically in the United States, the Dodd-Frank Act actually made gambling on derivatives possible for all banks, not just for a few. And the last time any liability was calculated, bearing in mind that these derivatives go both ways, that a bank might bet in one direction but also bet in another direction, the last time that some calculations were done, it was thought that there was a 10 trillion potential liability if there was a market crash. 10 trillion is still an awful lot of money, and we'll come back to that in a moment. Now, in Europe you may think you're pretty immune to this because laws in different countries vary. For example, in the UK you have to have it written into your terms and conditions, whereas in the US there is a nice little clause in the terms and conditions that basically says whatever we want to do, we can do it, and if you continue to bank with us, you're accepting our new and revised terms and conditions, as long as we've told you that there are new revised terms and conditions. They don't have to actually tell you what those are. And if you've had a funny letter in the post saying, oh, we've changed your terms and conditions, that doesn't say what they are, before you go and have a look, you might find it quite interesting. In the UK, however, what they've been doing is they've been signing people up for new bank accounts at an unprecedented rate. And this has been happening in other countries as well. It's been happening in Germany and France, where the banks have changed the types of accounts that they're providing and offered people incentives to sign up for these new accounts. For example, there is a bank here in the UK that offers you something like, I think it's £10 per month when you change your bank account to this new account. There's other banks that offer you big lump sums. My own bank offered me £200 to change my bank account, and this has gone up from the £10 that they offered me originally, and I've still got the same bank account. I don't want my terms and conditions to change, but lots of you will have already changed. So they've sneakily been changing the rules. Well, not sneakily because they're not allowed to sneakily, they've just been as sneaky as they can get. They've said we've changed the rules, they haven't told you what they've changed. You have to actually physically go and look at what they've changed, and if you've opened up a new account you may have assumed that the terms and conditions are the same as they were before, but surprise surprise, they won't be. So what happens now when a bank goes bust? Well, the US used to be relatively protected. It used to be the case that until the Dodd-Frank Act, that the first people who got paid off were the people who deposited money in the bank. And you might think that is all fair and logical, but the banks didn't think so. And neither did the government, because they didn't want to bail out the banks again. So what the government said is that derivatives come first. And derivative exposure and paying that off comes first before everything. It comes before pensions, and it certainly comes before you, the person that has lent your money to the bank. Although you may think you've deposited in there, you haven't, you've lent it to them. So, they will pay off the derivatives first, and we've already talked about how much that is. It's somewhere between 10 trillion and 240 some odd trillion, depending on how the market crash will happen. And you may say to yourself, well, that's okay, if I'm in Europe, my bank has insurance, Well, the liability of your bank's insurance is kind of governed by what they pay, and let me tell you, they're not paying very much. And in the USA, they're even worse than that, because they have this thing called the FDIC, which is the Federal Deposit Insurance Company, and well, they have a total budget of around 67 billion at the moment. That's up from what it was. It was 50 billion. But it's nowhere near enough to cover 10 trillion. And they went over, in 2009, they went over by 8 billion on what they were actually allowed to pay out. They had to pay it out, so they paid it out. And the banks, naturally enough, had to pay the interest on this. And a lot of small banks very nearly went under because of these interest payments. So if the FDIC can't afford an 8 billion overload, how's it going to cope with 9.8 trillion plus? And it's certainly not going to cope with 247 trillion. So this is the state that everyone is in. We don't actually have any control over what banks do with our money. In fact, if you give the money to the bank, it's not yours at all. I hope you found this video instructive and informative, and personally, I hope it makes you wish that you'd gone down to the bank, taken all your money out and bought a load of gold. And incidentally, in 2016, they're already talking about caps on the amount of withdrawals that you can have, and that's internationally. That's America, Europe, Australia, everywhere. And they're talking about tightening those caps. There is already a cap in some countries. In the UK, it's difficult to withdraw more than about £3,000 at any one time. You have to jump through all sorts of hoops to do so. So that's not looking too good, is it? So I'll see you soon. Don't forget to like, share and subscribe. Thank you very much.
Well, you could subscribe to Arduinotronic, or just go jump in a lake.